Property market is a bit flawed right now because the world is dealing with just a massive crisis. Like nobody could have envisaged this coming. This is like the biggest challenge in living history. I don't know whether you want to agree with me if you're watching this, but people, we haven't to just make it up as we go along. We haven't to be reactive. We're trying to be proactive. People always want to be proactive as much as possible, but we haven't to react to the decisions everybody else is making around you, and then you're having to place and move your chess piece. Now, in the property world, I had a valuation done just last week, and it was downvalued by 10% to what we thought. And I think I bought enough property now to kind of be confident in my end values. And so I even spoke to the valuer to get qualification on was my thoughts why they give the valuation that it was reality, and he qualified that as well. So he gave reassurance that they're being cautious. But that was just like well, maybe like a week and a half ago now, when this video is recorded, and that was just before they stopped doing physical valuations. So now you can't even get somebody to go out and do a physical valuation on a residential property. You might be able to still get one on a commercial. There is a bit of discussion that some people might visit commercial premises still. I don't know. I'm not a valuer myself, but let's just assume because of this scenario right now, people aren't getting out to do valuations. Therefore, there's more risk to people who lend money. And if you're in the property industry, most people leverage cash. They want to borrow debt. They want to take debt in a good way, and then they want to go and buy a property. That's normal in the property market. So right now, the best position to be in is if you're working with sophisticated investors or high net worth investors. And I got Joe Lynn on the call. Now we use Joe. He's one of our brokers to leverage debt, and I want to pick his brains because he's got his finger firmly on the pulse of what's going on, and also. I want to share some thoughts on what I think as well to help you, because you might be uncertain right now. You might be having some fears. You might be thinking, what do I do in this time? So just a few things from myself before we get Joe chatting. Like right now, if you are a cash purchaser, then in a few weeks' time, I think you're going to have far more opportunity than if you're trying to leverage private lenders in terms of banks and bridging products. Because just imagine you are that bridging product or the bank. You're going to be more cautious. You can't get your valuers out. The market, like the people are buying, has dropped. So therefore the values are dropped. Like it's just inevitable. Just think of it simplicity wise that is going to happen. And when the markets do become active again, it's going to take a little bit of time to start churning again. Like auction properties, like some auction companies have just ceased right now. Some are still trying to sell, but those 28 days, like the terms of auctions, like people are going to be more cautious. What if I can't complete? What if I put my deposit down? What if I actually comply with the auction terms and I can't deliver? So that's going to reduce people even buying auctions right now. So some auction companies have stopped. Some have still gone ahead, mine. I haven't looked to see what the results of those auctions are. Now might be a good time to get some cheeky little deals when everybody else is getting out. Who knows? But right now, if it was me, I personally would be pausing. The next couple of weeks, I'm taking stock. I'm looking around. I'm connecting with investors, high net worth investors, sophisticated investors, to say like, what can we do when the switches come on? So I'm not resting, but I'm also saying I'm slightly retreated. My big goals at the end of this year, like frustrated that I might not be able to get them. I'm just making new goals, and that's okay. Like it's okay to realign your goals, take stock, because everybody in the whole world is doing the same. So stop getting frustrated that your goals aren't going to get met. Like just make some new ones. So right now I'm taking stock. I'm looking at how I can work with people, and also what opportunities are coming. And that's going to be for another video, so stay tuned. By the way, what are you doing? Comment in the box below. What are you doing right now? Are you still buying? Are you slightly retreating and taking stock? But now let's hear from Joe, because he's got his finger on the pulse about what products are still available, what loan to values are still available in the market right now, and what he thinks crystal ball wise. He's not got a guarantee what's going to come in the next 3 months. It's his crystal ball to find out, Joe, like what's going on the lay of the land in terms of products.
Okay, so at the moment, I think lenders have really taken the same approach as investors need to. So as investors really need to be reactive, as you said, but lenders are really doing the same. So what we're seeing is lenders straight away reacting, dropping their loan to values, de-risking their offering. Now, some lenders have, in fact, reintroduced some other procedures that can enable you to lend with new applications at the moment. That will be via an automated valuation methodology. Now, the AVM model, that can be quite flawed. So do be careful if you are looking to take a new application out at the moment. You may not get the valuation that you hope for. So AVM valuations, they're obviously not a physical valuation. No one's going into the property to give it full justice. So it can't really be a fully justified valuation report. Now, Aldermore released yesterday that they were going to be doing 75% remortgages on buy-to-let limited company mortgages via an AVM methodology. Now, Aldermore in themselves, they do have a great offering, especially a low stress 5-year fix. Now, as I said earlier about being reactive to what's happening in this current landscape, I think really people need to be ready if opportunities are to be arising. So if you, exactly. So if you've got some properties in the background with some equity in them. Now, typically, one of the best things about Aldermore always in the past was their 5-year low stress product. Now, that is at 3.48, meaning that you can have a really low stress at 3.48. Now, really what that enables you to do is maximize your borrowing potential on that asset. So if you've got maybe a large family home that you're renting out in your portfolio, that can be classed as a low yielding asset. And generally, your mortgage would be quite low on that property because your rental income would not be enough to get you a larger loan size. Now, the way of increasing your loan facility on that would be going on to a 5-year fix. Aldermore are doing that even currently in this climate at 3.48 on their low 5-year fix. So that's a free valuation, free legals as well. So even in this current climate, there are still great mortgage deals out there, but it's just being creative and maybe looking at your current portfolio, how we can extract some cash and get some capital available to maybe buy cash ourselves over this period now where some great opportunities are available.
So maybe somebody's watching this and they're like first time buyer in terms of the backlet market. So some people often want to do the whole 80%. And if you're part of our community, like if you're part of our Tom Heaney Property Investor community online, or you're part of our academy, I'll always say, try not to use 8% products if you're holding them for cash flow. I always try and do 75% or lower just for like exits. So people who are coming new to the market, are some of the entry products now being taken away, or are they still available for people who are like first-time buy-to-let landlords?
Yeah, so as long as you've got your own home, then you're not a first-time buyer, and then the lending criteria with Aldermore, for example, would apply. So you could potentially get into the buy-to-let marketplace now at 75% loan to value with Aldermore using an automated valuation. Now, the risks of that is that obviously you might not get the valuation that you hope for. Now, it's a free valuation. So if you did not get the valuation you hope for, you wouldn't lose out too much on fees. So it can be worth a shot. But what I would say is that there are some great deals out there at the moment. Vendors are really weak and there are motivated sellers. So if you're in the marketplace at the moment looking to buy, you could be pleasantly surprised. Just so you know though, bridging at the moment is a bit delayed. So valuers are now basically out of work for a couple of weeks. Now, really the key reason behind this and the word on the curb is that there is a key insurance firm in London that is now not insuring the likes of Connors and Countrywide for professional indemnity. So it's not possible for them to carry out valuation reports because they haven't got the insurance to back it.
Yeah, and I think that's key. Like, so it, like, to de-risk somebody lending you some money, they want to go and get a physical valuation. They want to physically touch it and see the building they're lending you money on is what you're saying. And this whole PI, this restriction is obviously going to really impact on like the products available. It just, when you think of it as common sense, it just makes sense.
Yeah, absolutely. I think so. In terms of bridging, I think we will be having conversations with lenders over the coming months at maybe doing some AVMs at maybe 50-60% loan to value. But I really don't see bridging getting to 75% on an automated valuation. In May, I may be surprised, and hopefully that lenders do move in that space, because things on pause for a couple of months isn't beneficial to anyone in this economy.
Yeah. Okay. So if you're looking ahead, what do you think the market's going to do in the next three to 4 months, Joe?
Okay, so funding is very available at the moment in terms of how low the interest rates are. Now, I think lenders are really moving with that at the moment, so we'll see some new product releases. Valuations have just been the only problem, really. Like, lenders want to lend. It's just when you can't get a valuation, then how can you lend money? So it's not that finance isn't available. That's really not the case. This is a very unique disaster that's happened in this world at the moment with a virus, and you can't get a valuation. So it's not a problem with funding. So what I think is going to happen after this quarantine for 2 or 3 weeks, when valuations are back on, funding will be more available than it ever was, I believe. And what's going to happen, I think, would be a debt-fueled property boom, I think, is coming.
That's great to hear. Okay, and I hope that does happen. Okay, and so this automated valuation, is there any tools for people to work out what the valuation might be, so they can almost like do a appraisal themselves?
Yeah, so some lenders will use home track, some will use other methodologies. Now, other lenders will do a desktop, so they'll do, they'll scrape the sold data from the land registry and typically do an average. So, I mean, my advice always is on valuations for residential property would be to get 3 comparables dated within 6 months, within a quarter mile, and like for like, because obviously you want to be comparing apples with apples. So as long as you can get that, average the best 3 and maybe even 6 if you've got that data available.
Great stuff. So, so what's your game plan? What does the world of Joe look like then over the next few months? What are you going to do? So obviously you've got your business, that's not, which is obviously it's a service business. What about property world? What are you thinking about doing?
Okay, so at the moment I've got 2 purchases going through, so I've not stopped. Now, the one purchase is a £70,000 purchase. Before COVID-19 outbreak, we had a purchase price agreed at 115,000. We were going to do that with precise bridging, but the valuer went out, and the valuer had said that there was Japanese knotweed within 7 metres of the boundary post, outside of criteria for precise mortgages. Now, we didn't realise that because we'd owned the property next door, and actually the property we were looking to buy this time round had more land than what the property we owned had. So the extra land that we didn't know it came with was the part in which is affected by Japanese knotweed. So what we're actually doing now is looking to buy cash, split it away, so the Japanese knotweed is not 7 metres from the boundary anymore. And we'll just mortgage it then in its own right. So that's what we're going to be doing now going forward. In terms of other deals, we are looking at other deals. We're not going to stop for COVID-19. In fact, we're probably going to speed up our investing. Okay,
right. And then even right in the next week or 2?
Well, at the moment, I'm currently going through some remortgages, trying to get them completed so we can extract as much capital out of the portfolio as possible, so that if any new opportunities do arise, we can be ready, funding in place.
Okay, great. And so for me, like I've slightly retreated. And for me, I'm looking at the market for the next three weeks to then take action. So for me, I'm not doing any. I'm more observing and looking. So it's interesting. We've got slightly different models.
Well, actually, no. I mean, in terms of what I've got going through, that's sort of because it was going through anyway. In terms of opportunity now, I'm pretty much the same as you. I'm looking now over the next 2-3 weeks whilst I'm waiting for my funding to land.
Okay.
So yeah, I think it would be silly really to be a bullet agate right now. But I think it's crucial over the next 2-3 weeks to see what's
ready.
Yeah.
100%. Okay, so my advice to you, if you're watching this, this is what we're doing. I think Joe's doing the same. Is now is the time to get funding, pots of cash, access to equity, access to drawdowns, access to your investors, to be ready. That's key. Be ready. So that's what activities you could be doing in your time that you've got home right now. On our academy calls on a Monday night that I have every single week on our 12-month mentorship program, we're talking about this. We're saying, like, be ready, start getting resources, and and it's okay to just watch for the next few weeks and be slightly frustrated. Hey, well, I'm frustrated, but you can also use the time to do other things like connect with family, friends, reconnect with people you've not spoke to, speak to people a lot more, because people have more time on their hands on the whole. Okay, so if you enjoyed this video, tell me and Joe, what is your game plan over the next few weeks? Like, let me know. We will look at these comments and we'll engage. This is all about community, okay? And if you're interested, there's other videos that you can watch to help you get ready and be ready in the next few weeks. If you enjoyed it, give us a like, give us a subscribe, and tell your friends. And see you on Facebook. My name's Tom, and that's Joe. Where is he? There he is. See you on the video. Take care.
Thanks. Bye.